Hey guys, back to the balance sheet. So just to recap, we talked a little bit about current assets last week. These guys right here. Oops, not those guys. These guys right here. All right. So today we're going to dive a little deeper into our current liabilities. So, this is where a lot of business owners can get tripped up because, like, for example, and we'll talk about this in more detail later, but these current liabilities not getting recorded properly can mislead. This is why these are the accounts or the balance sheet line items, whatever you'd like to call them, that can really mislead a business owner that is doing management by bank balance, okay? They see, oh, I've got all this money in the bank, but then they don't realize that, well, I've got all this that I have to pay. Most of the time, these current liabilities, I know that the definition of current means, within a 12-month period, but most of the time, these bills are due far sooner than that. Payables, depending on the terms that you might have with the vendor, are going to be 30 days or 15 days. I know we do 15 days. Credit cards, those are obviously not really out there that long. We'll talk a little more about current or payroll liabilities in a bit, but Let's talk a little bit more about what each of these really means. So anyway, by the end of this video, though, you'll understand a big portion of why your cash flows are choppy and kind of all over the place. And this having your current liabilities accurate is one way that you can really understand your true financial position. So anyway, let's define these a little bit more closely. Let's start with accounts payable. So accounts payable represents those invoices that you might get from clients. Like, for example, I talked a little last time about how the invoices that I send my clients, which creates accounts receivable on my books, is a bill to my client on their books. So it's the exact opposite. The inverse is what I said in the last video. The inverse of accounts receivable. Okay, so if I were to invoice a client for $1,000 worth of services, they would see that bill. That would be a $1,000 bill that is going to be sitting in their payables for that. So anyway, that's what accounts payable is. Basically, it's for services rendered in one period, and you're paying them in a future period, right? So to kind of go back into it a little bit more deeply is, you received those services today, but you're not paying them until sometime next month, right? And that's what payables is, okay? So now, obviously, credit cards, that's kind of a no-brainer in terms of definition. We all know what credit cards are. It's a very common tool that small business owners use. I use it myself. And so anyway, the expenses are incurred when you swipe that credit card, and then you pay it later, all right? So payroll liabilities is what is due to your employees at the end of the month. However, it's paid in the subsequent month, right? So we're coming up to the end of December as I am doing this video. So for the work that my team does between, let's say, the 16th of the month and the last day of the month, accounting wise, that needs to go in December. But cash flow wise, it's paid in January, right? So basically, payroll liabilities is a mechanism for getting the expenses into the proper period. At the last day of the month, you're going to have those payroll liabilities on your books, and then they get paid once you run payroll and you pay your people. Okay? So those are all considered current liabilities because you pay them so quickly. One example that is actually not listed here is related to the long-term liabilities, and that would be the current portion of long-term debt. Okay? If you have a note, you know what I'm talking about. You're paying payments every single month on that long-term note. It may not be due until 10 years down the road, but you're making payments today. So if you take those payments and you multiply it by 12, that's your current portion of long-term debt. Okay. Now that's not listed up here, but it would be considered a current liability. So let's just sort of recap. Current liabilities represent those short-term liabilities. They're due within 12 months. And it's really going to, if these are stated correctly, they are going to really help with cash flow management. Okay. And again, this is the whole reason right here where I am so against the small business owner clients that I have, where they just manage their business by bank account. And that's just a terrible way to do it because, hey, on this balance sheet, for example, we've got $20,000 in cash and you're thinking, oh, that's great. But look at the liabilities that I have, short-term liabilities of 30, that's not so good. Okay, so that's where we have to make sure we've got both sides. We've got current assets right as well as the current liability side right. So anyway, if you have questions, drop them in the comments. If you have something you want me to talk about in the future, put that in the comments too. I'll make a list and I'll be sure to discuss those at a later time. And if this is helpful to you, please like and follow our page. So you guys have a great day, and I will talk to you tomorrow when we talk about non-current assets.